Well, good afternoon. Today is going to be a two-part class, so really pay attention. You're going to hear some more deeper information today, some more research we've got. And to start off with, it's very important we both speak the same language. So we've added a new member to our staff. His job is, he's what's called a quantitative analyst. Who knows what that means? 1, 2, 3, 4 people. Okay, so that's kind of a unusual word, right? Let me give you another word that may make more sense to you. Think of what Dave does as a statistician. Everybody knows what a statistician is? Okay, so that's what we're going to be real today. A lot of the research, this is the foundation to try to get more performance out from models, absent taking more risk. In addition to that, we're going to share another model that's been requested of us for a number of years now that'll be available here in the next month or two. So Alex is going to start off the presentation, and then Dave Berstrom will also add into that, and be sure to ask any questions that come to mind.
Thank you. Okay, so today I'm just going to briefly touch on some things because I know we have some new clients. We're always going to swing back and try to recap on certain topics, and then as we push forward, we're going to be slowly adding more layers and layers to this cake so everybody can understand at a really deep level what's going on here at JCN. We do all of our research in-house, and today I was trying to think of the topic for this presentation, and the Indy 500's going to happen, and I was like, it's like when you go there and they have those private locked tents, and you don't know how they're building that car in there. But today we're basically let you come into the back room and see how we're basically building the engines here, and hopefully you guys can take away some more information of how that works. We've been using one strategy here that was designed with us. That's called persistent value. That's basically what everybody's been invested in so far the last 3 years. And recently we've had some clients ask if we can build another strategy that's got a different goal. The one that we have right now that will stay in place in perpetuity is really designed to have less risk than being invested in the S&P, and over a 3 to 5 year time frame have a net return of 3 to 5 points excess of the market. And again, that's the S&P 500 benchmark. So we're going to be launching here this year a different strategy that we've sort of designed in an opposite opposite direction. The original strategy was designed with risk in mind first, and this new one will be basically more aimed to be a performance type model. So it's got a lot more horsepower, but again, it will have much more risk associated with it. So it will not be appropriate for every single one of our investors, clients. Again, the way we measure it is over a 3 to 5 year time frame. We're looking to get somewhere in the ballpark of 10 to 15% over. So quite a bit more return there. To kind of explain in this part one how we're going to get there and what goes into building this, we're going to touch on some few basic concepts: what makes a good stock versus a good company. Dave's going to go a little bit deeper into the modeling and testing so that you guys can get a better understanding. And with that, I'm going to let Dave talk about his background and some of the things he do here for us.
So I'm obviously Dave Berstrom. Nice to meet you guys. I'm sure I will over the coming years or so. And a little bit about my background is I come from a high-frequency trading firm, market-making firm, where we specialized in big data analytics, machine learning, and artificial intelligence. So what I'm brought here to do is to add data oversight and some empirical evidence that we know that we are making the best investments possible, as proven by the data. Moving on, pass it back to Alex.
Yeah, so one of the things I like to put in some of these slides is just to reiterate some basic concepts. Why do we invest in stocks at all? I mean, why don't we just put all our money in gold or real estate or bitcoins or whatever? Why is it the best investment? And we found this one passage here is really quite simple. It's because stocks have the ability to compound their growth over time like no other investments that we're exposed to. And the reason that is so is because they can basically take their profits that they retain and they can reinvest it in the business. They can buy new factories, they can hire new people, they can move into different industries. You know, like Google used to just be a search engine. Now it's a driverless car, you know, program and so many other things, mobile phone software provider. Amazon used to be a bookstore online, now it's a grocery store. You know, so these companies are growing in a lot of different ways. And that's what makes these stocks able to perform much better than really any type of asset class. You know, such as real estate, there's only so much land in America that can be rented out. So at some point, there's just a diminishing point of returns. So that's really why we focus so much on this asset as our growth vehicle, is because it just statistically has a better probability of giving us that growth potential. So why are we always doing this? Or what's the goal of this new research or the research we're building here? We're always searching what's called alpha. Alpha is essentially the excess return over the benchmark. The benchmark typically is just the S&P 500. And with all the research that we do, really what's kind of interesting is you would think, you know, from a logical sense, oh, we're just trying to pick the best stocks to buy. And in a sense we are, but what's actually way more important that you guys have heard before is we're just trying to exclude owning the worst stocks first. That's actually a much easier first step than actually trying to pick the single best stock to buy. And so we're going to go over how that statistically works and some of the concepts behind that. Dave here is going to talk about some of the procedures.
So some of the stuff I've begun doing is building our database. Originally, when I came, there was a database of historical prices, of course, and all of the company's performance metrics as reported in their quarterly and annual earnings. What I've done is we've expanded the database to include every metric we can even imagine, and we've even created some of our own off of the existing data. So we're looking at things, free cash flow, return on invested capital, all the standard stuff, and then we're combining them in unique ways to create new information. A lot of that has been in the database. And then, of course, once we have this database, right, we have this big sheet of cookie dough. It's now time to actually make cookies out of this and find models that work for us. And when you do that, you find data-driven strategies. There is pitfalls with just blindly trusting the data. So the next phase of what we're working on is not only finding what the data is telling us, but then validating it. And coming through this, I'll mention them in other slides, but just to bring them up now. Selection bias, survivorship database, real quick, companies like Enron or Lehman Brothers, at one point in time, they were the breadwinner, they were the lead stock. But a lot of databases don't include them anymore because they've gone bankrupt and the companies that provide the data no longer want to carry bankrupt stocks. So when you go and you build models off of data, if you don't have that data, you can easily be fooled by your test that doesn't include these delisted bankrupt stocks. So we've added all of the delisted stocks to our database so that we know that our data and our research is as accurate as can be. The next thing, we're doing hindsight testing. We're not going back and saying woulda, shoulda, couldas. We're actually looking forward and trying to simulate forward. And with simulating forward, we have a various suite of tools and stress tests that we can apply where we're basically simulating the future so as the market evolves, we can be ready for whatever the market throws at us. We've seen everything the market can do. We've simulated every possibility we can think of, tens of thousands of simulations, and we know the risk that comes with each one of those possibilities, and we only invest when we're comfortable with that risk over this forward testing.
So what does this actually look like? This is in this process, which is different than our original model, it starts what's called a scoring mechanism. We essentially grade every single company at that point in time with just a letter grade. So we break it up by quintiles in this example. This is like A grade, B, C, D, and then F. So whatever way we decided these stocks are letter A, maybe it's profits or it's sales, whatever's so good, we take the top 1/5 and we put them in this bucket. And then we measure what the performance is of that bucket versus the entire universe of stocks, so the entire market. Because if the market does really good and our buckets did good but not as good, we want to basically know what's the base level before we make any judgments. So in this case, the market made 69% over that period of time. Compound average growth, those A-rated stocks are 20% return. the B-rated ones are a little bit less, and then the C-rated ones are 17. So what's interesting here is, look, if we just only bought A through C, you get a little bit more return than the market. But what's actually easier is just to not buy these ones, right? That only made 7. So it starts with a little bit higher lens, a little bit higher altitude in the build process than going directly into every single company, which is sort of what we do now. It kind of just starts in higher groups. And so the way these stock picking ranks are tested is we basically just test, what if we buy the stocks today and just hold them 1 year, just to see how they do over a 1 year period as a base level. There's no risk management on this yet, meaning no stop losses and targets. It's just how good is our company picking ability based upon this model. This is what it looks like at the most detailed. This is basically bringing in all the different metrics. I don't expect you to see or read a lot of these things, but I just meant to show that we're really looking at a lot of different facets of what goes into these scores. So, not only the gain, what's the maximum loss of those basket of stocks? That's actually more important sometimes than how much money they make, is how much money they lose, what their beta and alpha is, so what their behaviors are versus the market, Sharpe ratios and whatnot. But essentially there's a ton of different DNA points, data points that we create statistics on so that we can look at a whole array of tests and say, okay, this is something that works very well in the market. And what's interesting is sometimes the market itself does very, very well. So, we might do all these tests and even the scores at the high end aren't good enough to really just be out of just the S&P. Sometimes it's a great strategy just to be in the S&P. So what goes into those scores? Well, we break it down into factors. Anybody remember what that means? We kind of talked about it with Chris Kaufman when he was here. Factors are these key attributes to a company. So earnings is a factor, sales is a factor, what sector they're in, how much debt they have. We always basically focus on one attribute and say that's a factor. And that way when we change it and we test it, we can compare different types of companies in different baskets. And so what this study shows is we did in this grid, the smallest companies are here on the low end and the larger companies are on the high end vertically. In addition, what we did is we say, okay, let's look at this one factor, earnings growth. So just how much did those earnings grow over 1 year period? And then in the box, it's how much that group of stocks returned. So what this means is stocks that had the worst earnings and are the smallest had a negative 14% excess return, meaning it lost to the market by that amount. In addition, the largest stocks, the biggest stocks like the Apples and the Amazons that had really big earnings had 12% more return than the market. So this is basically showing in hindsight, preceding, what did those groups of stocks do? So the problem with this is when we look backwards, we say, okay, the year went by, 2017, we go, all right, which stocks did the best in earnings? Well, these ones did really, really well with high earnings. What if we bought those and then turned around and held them into 2018? Let's see how they did. What is going on there? The ones with the highest earnings basically barely beat the market. Not a ton. Even the ones that had the worst earnings barely beat the market. Now that's weird, right? I thought earnings make stocks go up. The thing here is stocks are so efficient at pricing in the future that the ones that had the best earnings this year provably don't really make that much of a difference going to next year. That's just one factor at a time. So that's kind of interesting. What if we did sales, right? Sales are a pretty big thing right now because you got, Amazon with 100 million Prime subscribers who, sell whatever million items a minute. And these stocks are really hot because everybody thinks the sales are just going through the roof. Well, in hindsight, if you looked at the past year, which stocks did the best because of sales, high sales seems to do pretty good. But again, let's turn around, buy those stocks, and then walk forward next year. Again, there's nothing really there that jumps out. I mean, the ones with low sales obviously don't do well, but you're really not getting like a ton of outperformance by buying the stocks with the highest sales. So that's kind of weird, you know, it kind of goes against the logical thought there. So those are common factors, and those commonly used factors over time have really stopped working in their predictability of the stock price. We look at a lot of other different factors, some that are not really well known, that you have to take parts of the balance sheet and the income statement and kind of create different ratios so that you can see what's going on in that company in a different way. This one is one that we focus on a ton. It's called free cash flow. And what that is, in simple terms, is say a company pays all its bills, it pays all its rent, it pays all its employees, pays all its debt, you know, it's done with the bottom line. What is the change in the cash, basically the checking account, that year? And you can see ones that had the highest free cash flow growth had huge outperformance, 30% over the market. Again, remember, this is you know, perfect hindsight. You know, if we go forward, buy these ones going to next year, there we go. Now we're starting to get a lot more, not a ton, but you know, that's pretty significant outperformance in all classes. So small stocks, bigger stocks, all the way up to the biggest stocks. That one factor seems to do really well. In addition, all the ones that had the lowest, like their cash shrank, they actually underperformed. So that's even more telling, right? It works on both sides. It works in a negative way and it works in a positive way. So there's something there. That's essentially what our data mining is looking for, is parts of these companies that will be predictive for us going forward. And again, it's aimed at trying to get that outperformance. So really what this is trying to output for us is a lot of these different combinations. And I know there's a lot here in these graphs, but it just is meant to show, you know, we're testing all these different things to try to see which companies have the best factors, and essentially different companies have different types of behaviors. Like a utility company creates electricity. They don't have a ton of growth. You know, they're just kind of steady, you know, choo-choo train-like businesses, but something like, you know, Google or Amazon are just growing leaps and bounds. So they're not going to have the same features. And so we have to be very aware of that going forward. Dave's going to talk about what creates a strong.
Right, so just to summarize from my point of view, what Alex is saying is we are constantly looking for the factors that will lead to future performance. And we've been very creative in finding sector-specific factors, because as he mentioned, you cannot compare new technology companies to old utility companies. And then once we do that, and we find these factors that we think are predictive or will help us find better stocks, there's a couple of ways that we can actually validate that these factors are actually predictive. The best way is obviously to compare against the future benchmark, right? So we'll look, as Alex said, a year forward. The other way is we can compare it against the other quintiles. So we break them down into A, B, C, D, F, and then we just want to make sure that if they were really predictive, then moving forward, the A's will continue to outperform the C's will continue to outperform the F's. And then the other ways are, of course, I just mentioned over other sectors, but of course over market conditions, right? Are these factors predictive when the market changes? And if they're not, then we need to find new ones, and that's what we're constantly doing. But if they do remain predictive through various market conditions, we can have a lot of confidence that it's going to continue to do well for us.
So, do you have the quarter? We're going to play a little game here about probability. Hopefully it'll be insightful. But say you have, you know, two opportunities to invest in a company. One hand here and one hand here, or basically different investments. The only thing you have to go on is essentially these coin flips on how or if to invest in each one of these companies. So the first flip is going to be heads, tails, heads, tails, so on and so forth. So essentially has a random probability or even probability of 50-50. That's investment. So
let's say Alex does 10 flips and finishes with 5 heads. I do my 10 flips, and I finish with 8 heads. Now, if you had to bet and invest in one of us, do you really think after 10 flips that I'm a better coin flipper than Alex, right? Probably not. But if Alex and I were to continue playing this game, and he were to flip it 10,000 times and get 5,000 heads, and I were to flip it 10,000 times and get 8,000 heads, you might have a little confidence that maybe I am actually a better coin flipper. So what we're trying to do is when we look at these factors, if we find a fund or a stock that's maybe done well for 1 year, that's not very impressive to us. If it's predicted something once or twice or 10 times, it's not very important to us. But if we could find a way to simulate it or to find data that matches it, to do it 10,000 times, and it remains predictive over that large of a sample, then we have confidence to include it in our model. So a simple example is 30 coin flips. You can see how much it varies, right? 40%, 67%, 37%. So even though we know a true coin flip is 50-50, but with a small sample size, it's not the case. So as we increase the trials, you can see we move closer to 50, but still a lot of fluctuation, right? And then if you move to 10,000, you can see it's all 50%. So what we're trying to do with the data analysis is find these predictive factors and then simulate them forward and match them until we have enough data, until we can be confident that the law of large numbers will play out and we will actually get the obtained edge that we found.
Absolutely. So that is essentially what's going on in the basis of the statistics. The other biggest problem that we really want to kind of, bring to light is this concept of selection bias. And the financial industry as a whole, mainly the publishing industry, is just really rampant with this, where they'll come out with a new fund or a new product or whatever, and it looks just absolutely wonderful. It's just going sky high. Always just, we're going to be double our money every night. And it's just one of those things that it happens with analyzing the data in an improper way. With these mission critical models and investments, or even healthcare now, they simulate millions of times before they let the first person test a drug, right? They're not going to basically let anybody take something that's harmful now. Essentially with military games as well, they play a lot of different simulations, so they know exactly what's going to happen before they waste any money, going out and doing something like that. So the point is, the process is actually much more important than the results sometimes of how it was attained, because the results can be, found almost by random.
Yeah. So just to make a couple examples, healthcare. If there's a test, they test a pill on one person, that person lives, they're cured of their symptoms. Are you going to take that pill? Probably not. One person is obviously not enough to prove anything. Now, the one problem is in statistics, assuming a normal distribution, if I run 20 tests, I should have one that's very good and one that's very bad just by pure luck. Now, if we do 10,000 simulations and I find one factor that's predictive, I don't have a lot of confidence in that, because that could just be this one lucky one. So we have to run a bunch of tests to validate that the good things we find are actually valid and will remain true and not found just because of luck.
So I like to throw this cartoon in there because I really think it's basically perfect representation of the news nowadays. It's the would've, should've, could've investment hindsight show. Of course, in hindsight, we're all millionaires, and this is so easy to do, but it really isn't. It's a game of inches, and this survivorship bias issue is a key starting point, because one, these databases are really hard to attain. We actually went to the length to build it ourselves so that we know what's in there is actually of reality. He mentioned before, companies like Enron or Lehman Brothers were A-rated stocks at some point, and you can't say, we just never bought a bank in 2007, because at the time, I bet you the model was trying to do that. Even other situations where, like Green Mountain Coffee, wonderful company, went up hundreds of times, got bought out, went private. You have to have those in there too. Dell went private as well. So you got to have both of those in there to really remove this Monday morning quarterback issue. And we have some clients that bring in newsletters and pieces of software that I just know for sure don't even address the survivorship bias issue, and that's why they look so amazing. John has stories about IBD where they come out with this new great index or a way to invest, and then it tanks, and then they just come out with the new one, and then that's the new rage. So they just completely forget about the one that just happened. So the reason that happens is they're really a publishing company. They're not an investment company. They're not responsible for client dollars. And just be aware of that, as this is a much different process.
So another test we do is called in-sample and out-of-sample testing. So imagine I take the data from the dates in this blue shaded area, and I keep them in my back pocket. Now we take our factors that we think are predictive, and we invest over these years, and we find something that we think is really good and will hold up. The next test in our process is to pull this data out of our back pocket and then test it on this unseen data. And if this data, if our model continues to perform well on this data that we've withheld from our research process, then we can be confident that the model will continue to do well on new unseen data. And that really brings us to our next step of stress testing the model we have. So for stress testing, there's a few things we can do. We can look at the historical results, and we can remove the top performers, because let's say we were lucky enough to identify Amazon before the big run, right? And all of our performance could have came from that one stock, and maybe we won't be that lucky to pick that winner next time. Another thing we can do is randomly remove some performers, and maybe we don't want the weight too concentrated in any group of the stocks in our portfolio. Another thing we can do is Winsorize the data. So let's say that our best stock had 150% return. What if we just reran the results, but we limited it at 50% and we chopped off that 100%? Is the model still good, or does it rely on that extra 100%? And then noise testing is really the next phase. What that does is it takes historical price data, and it's going to add and subtract random amounts of volatility to it. And then what we'll do is we will trade the model over these new synthetic price data, what this does is it allows us to simulate future forward possibilities. So whatever the market can think of, we're ready for it, we've simulated for it, and if our strategy holds up on all these infinite new universes, then we can be confident that it's ready to go live. And then the other thing we can do to get that law of large numbers is we can take our model and test it, not invest it, just test it on other countries' stocks. What that does is just gives us more data to play with to make sure that whatever we think is predictive everywhere on a large sample, so we can be confident in it.
So with all this scientific stuff, why aren't we all rich? Why aren't we all filthy rich? I mean, it is a very tricky process. And one of the reasons this is so difficult is there's a lot of other high-end hedge funds and firms that are doing this exact same thing. So if we find something that works really, really good now, chances are someone else is going to find it as well, and it might not work forever. It has to be evolved over time, at least in this pure alpha type strategy. A good example is like book value versus technology that I mentioned before. A lot of the investment books, like How to Invest, were written in the 60s, when there was, car factories, steel factories and locomotives, like just totally different companies. They had assets. Now it's all about software, subscribers, virtual reality, apps. It's a very different economy. And these companies, they don't have a lot of stuff, they just have software. So a lot of these things are changing. You have to kind of see those changes if you're going to catch a lot of the next best performing performers. And so, the last thing I'll leave with this, why aren't we all rich, is it takes time for these inefficiencies we find to play out to our benefit. It's not a trading strategy where every single day we're going to make 0.5% up and down. Let me go forward. Again, we acknowledge that newer clients that got invested before the beginning of January year might have slightly different returns, and that just happens from when you get invested. But when we report any numbers, we have to do what's called a composite, and we have to report net earning, or basically net returns. And so, this amount is plus or minus. We were ahead much more in January, but we're still kind of holding on to a little bit of alpha there. The one thing I wanted to point out that is more interesting to us is the bond market. Interest rates are rising, and even though our bond portfolio is down a tiny bit, you can see these other parts of the bond market really went down a lot. So we feel that even though we didn't lose this money, it's sort of a gain. You know, we've gained 5% by not being in this treasury bond market. And you know, one of the things that we're always looking at is what does the macro tell us about when to get out of the stock market. And you know, this is the economy right here, this dark blue line. And if this were to start going down, represented by here, that's when we get 100% out of stocks into cash. So we're very, very far away from that. Everything is still very, very good. And this, in our view, could be an opportunity because the economy is going up, stock market's gone down a little bit. You know, let's try to find another time it did this. Well, stock market's going down here and the economy's going up there. You can see it kind of corrected its course. So I'm just going to leave it there. Any more questions? I'm going to just flip to the end because all these are space savers. But feel free to ask now, and thank you for coming.
What about the Chris Kaufman model? Is that still?
That's just going.
That's still going to be used.
Yes, and
is Olivia going to be on top of that, separate from that?
it'll be pretty separate. Yeah, like I said, we didn't want to basically replicate by using that technology again because we're just going to kind of get the same results. So we want to design this in an ensemble way where it's essentially a different approach and hopefully get a different outcome with different data points. So it could be run together, like if you wanted a portion in one and a portion in another, I guess you could do that. I don't think John would really recommend that for most people, but it is just something we're working on as a second product.
But the data that's mined into Kaufman's is different than the data that you guys are mining?
Mm-hmm. Yep, it's different. They own their database, and we basically build our own here, and they're separate. So it's going to be a different algorithm essentially. The data itself actually could be very similar, what it's using, but we just in this one we're not going to use the price wizard valuation model, which is not a bad thing. I mean that thing's been working really great. It's just a different type of design. So it's a good question.
So yours will only be in the Olivia.
Yeah, this is just sort of a completely different approach.
Can you generically talk about what's going to be your way to recommend or not recommend that to people?
That's basically up to John, but it'd be more for clients who are a different goal and different risk tolerance for sure. We fully believe that what we've been running for 3 years is working amazing, and it just continues to be appropriate for most people. So a lot of what's in this other model will also give us some insight that we'll be able to start to share other than just the model is this. You know, we'll be able to show earnings and stuff just from our data points. So any more comments?
Yeah, I mean, I think Alex really hit the nail on the head, but in a month from now, we should have the full risk overlay on the new model, which will be much more in-depth and data to give to you guys to kind of help make those decisions, I think, with John.
So that's it.
Full-time, Dave?
Slowly. In the last couple of months he has.
When the volatility struck earlier this year, how frequently did you have a stock hit your stop and fall below it for you to buy back and take the uptick?
There was a week where we were stopped out, and then it basically says, don't wait, don't put something in a new model. So we would basically sell one to buy the other, and then that would be like 2 or 3 at a time, and then the next day would go by and those would stop out. So there was a big turnover there for like 2 weeks. We didn't buy back into anything quite yet. When we stop, we just buy the process, have to wait. Some of the companies that we bought are even above, before where we stop, which like I said is a bummer. Like we'd never like to see that, but what's good is, say come October and we have an empty spot, we can put those stocks back in. If they're still undervalued, they'll basically be.
I was just curious because I know I saw at least twice in that quarter, like ExxonMobil dropped from 80-something down to 70.
Yeah.
And then probably turn right around and head back to 80. It seemed like you could use the volatility to an advantage at that point.
We did get a little bit of that. We also got the other side of that where, in this sideways stuff, we very, we acknowledge that it could be a time where we underperform a little bit just because we're getting that ping pong effect where we're going along, oh, we stop, we reload, goes up, oh, stops again. I mean, those stops chunk a little bit of return every time. So luckily for us, it's calmed down a bit. And I think it's smooth sailing towards the end of the year myself. So it was just, we went through an abnormally quiet time. Remember, I was saying like, this is so good. It just don't, you know, remember, don't feel like this is going to be every day. And then now we're kind of getting a little bit opposite of that.
The risk aversion part of it is to have the stops in there. Now, the new model, is that?
It probably will have something similar, but it'll be more aggressive. So it'll allow a lot more volatility. And that just, you know, that's needs to be understood from the get-go. It's in order to get that more, 10% over, you got to kind of be able to live through some of those bigger swings. So I don't know what it would have done during that period. We can look at that when we get closer, but it'll be interesting to see for sure.
Is your stop loss always set up at a percent or a certain dollar?
It's actually a probability-based stop. So it's sort of designed to where we don't want to get stopped this percent of the time. So it does a calculation based upon that rather than a percent.
With range in mind.
Yeah, so,
Recent volatility.
but over the lifetime of the data we have, on average, just on a total average, if we get stopped out at like the worst stop, it's usually between 20 and 15%. It's totally manageable. That's just from what we've seen over how the model is created, but it's not a hard, we're out at 15.
So it's not an automatic trigger, you have to look at it and say, yeah, we're gonna go ahead and hit that or not.
Yeah, so it's basically automated for us, so it tells us where the stops are. We don't have resting stops in the market, meaning we don't put an order in the market and then when it hits it, we sell, because we block trade everybody. So what happens is we hit the stop, we usually don't sell like right at that second. I'll block up everybody's trade, and then I'll call the trade desk, and they basically tell me the best time to execute that. And then that way they can just go get it done for everybody at one price. And that way it's just much cleaner. It really would be difficult if half of them got filled and everybody else is like still going down. It's.
The Exxon example, did you hit a stop loss on that?
Not on Exxon. Yeah, in the model we're using for everybody, a company has to have positive earnings for 3 years in a row to even be considered. It's kind of a safety mechanism. So with a lot of these energy companies, Exxon is one of them, you've really only had maybe a year and a half of positive earnings quite yet. So I wouldn't think any like pure oil-centric energy stocks would get into the list probably for another year.
So you weren't invested in that?
Not in Exxon, no. We actually haven't had any energy stocks in, I don't know, a couple of years, yeah. And it's really, like I said, a safety mechanism. It's not that any of those are bad companies. A lot of them are really undervalued and doing amazing right now. I mean, Chevron went from 65 all the way up to 140, and we missed that whole thing, And so it's not going to catch all that move just by design. So that's a good question, though. Yeah, thanks.